Hi, this is Sheraz Mian with the fundamental view of the market. I have jotted down my arguments in a bull-bear argument framework, and they are in my slides. So let's just jump into the slides to see what my points are. So as you can see here, the most important element in the bull argument is the outlook for the economy. It still remains very strong, even though growth is on track to decelerate in Q3 on account of Delta and some of these supply chain issues. But growth beyond Q3, particularly next year, while not getting back to what we saw in the first half of the year, is still very, very strong. And then the key economic actors, households and businesses, remain in excellent financial shape. Households, particularly, unlike most economic downturns, came out of the COVID downturn in flying colors. The labor market remains very strong, as we saw with the September jobs report. And the balance sheet, household balance sheet, is in extremely good condition thanks to the very generous fiscal support that Congress gave the economy. We had some favorable trends, strong, enduring favorable trends, particularly in housing, but also on the factory side that were in place pre-pandemic. And the housing side of that trend actually got a boost through the pandemic that still remains in case and should remain a key source of support for the economy. And then interest rates. Even though long-term yields have nudged up a bit, they still remain very low by historical standards and very friendly to the market. So if we get to the bear side of the argument, the big issue is the question of inflation and whether and to what extent the rise in prices, inputs, commodities, transportation, payroll is a transitory phenomenon, as the Fed believes and as the market, the consensus view of the market, appears to be on the same page with the market. And the bear case is that this transitory view of inflation is a risk factor. And related to that argument is the view that should this thesis of a transitory inflationary pressure turns out to be wrong, and the resulting adjustment that the Fed will need to make to its monetary policy stance, this argument says that the market is way too sanguine about that adjustment. This will be a very dislocating adjustment in the bear argument, and the market is not sufficiently pricing in the odds and risk of that. Then there is some pandemic-related damages to a few sectors: leisure, hospitality, aviation, and those damages appear to be a lot more enduring. And then there's question about valuation. Valuations, all conventional valuation metrics remain on the high side. In fact, the PE multiple, forward 12-month PE multiple for the market is currently where it was back at the time of the tech bubble burst. So to put it all together, on the main question of inflation, I'm fully on board with the Fed view and the consensus view that the issue is a result of this once-in-a-century adjustment that the U.S. and global economy had to go through. We are still in the pandemic. the economy, U.S. and global, has started normalizing and adjusting to the post-pandemic world. And I'm convinced that we will see these pressures and disruptions normalize and ease out over time. We have seen a number of bellwether operators, like even the early Q3 results from FedEx and Nike and Bed Bath and Beyond, talk to these issues and essentially refer to them in a transitory issue, in a transitory fashion. I do expect these to work out. The valuation question, I think there are some areas of the market that one could legitimately argue are a bit stretched, but on the whole, valuations remain reasonable, particularly when seen in the context of where interest rates are. As I mentioned earlier, the S&P 500 is trading around 21 times forward 12-month EPS estimates, which is approximately where the index was at the time of the tech bubble. But then at the time, the 10-year was yielding north of 5%. Well, we are definitely under 2% and staying there. So hard to say that we are in bubble category or stretched region in valuation terms, given particularly the interest rate environment. The Fed is preparing the market for quote unquote normalizing monetary policy, but it'll remain data dependent. There is the thinking that perhaps over the next few months, the taper announcement will come, and then at some stage next year will be the interest rate adjustment period. This is something the Fed has been actively sharing with the market. There's hardly any news to this issue, and I strongly believe that the market will see the Fed following through on this plan as a positive for the market and the economy, and not otherwise. So yes, there are some pockets of the market where valuation is stretched, but there's plenty of out of favor areas of the market where you could have quality stocks at still reasonable valuation levels. In fact, all of the cyclical parts of the market have reasonable valuations and very, very strong fundamentals. I've long been of the view and strongly believe that you don't need to, particularly if you have a long-term view, you don't need to perfectly time the market. You could start building small and keep adding to that. There's always an opportunity to add quality stocks at reasonable prices that will give you significant upside in the long run. So on the whole, a very positive outlook for the market, driven by and reflected in fundamental factors.
Hello, everyone. I'm Jeremy Mullin here with your technical view for the market. Let's start it off with a chart I showed you guys back in July. This was the S&P 500 grinding up. We had this perfect channel with the 50-day always showing some support. I had drawn this little fib here showing we had hit some targets and we might pull in, but then we could also go to the end if the market got out of control, perhaps even test the top of this channel. So fast forward. What happened? Let's go back to July. We did see a sell-off of the 50-day, which held again, back up in the grind. 50-day held, and we got those targets almost, like 3 handles away. Good enough, right? So eventually we pulled back here to the channel, and the 50-day lined up perfectly, and it broke, right? And we saw this big move lower, but a snapback rally to the 50-day, and another move down, making lower lows. Lower lows is not good. But we snapped back again on the debt relief rally. We kicked the can down the road, and we had a nice rally back to the 50-day, and we're kind of hanging around this 4,400 level. So the bears are in control here shorter term, and we are trending lower. We're below moving averages. We have the 21-day ticking lower, and they're going to try to push it. They're going to try to push and get us down to here, to the 200-day moving average. So let's see how they might get there. I have from lows to highs a fib at the 43.40 area, and overnight futures gapped lower, and it looked like maybe we'd test this, but it held up, and we bounced back to the 4,400 level, and that's where we are now. And if we can get a push lower and this area breaks, the 4,300 level will be taken out, and lower lows will be marked again. And we might need some news for this to happen, so we might chop in this area a little bit. But eventually, we could come down to this 200-day and these fib targets of 41.85. The 200-day will be rising. Perhaps this lines up at some point in the future. And this could be the spot where we go, and you can have a viable pullback. And I think, if you sit on some cash, this is what you're looking for. Looking at the NASDAQ, or excuse me, this is for the bulls. If the 50-day is taken back by the bulls and we get back above 44.50, we could really trend higher into the end of the year. So watch out for that 44.50. I think that's the big level, the big line in the sand on this bull bear fight. Looking at the NASDAQ, this is the chart back from July. We extended higher once again. We were looking for the top of this channel, and fast forward, here we are. Didn't quite hit it, pulled back, broke the 50-day snapback rally, broke down to the channel. The channel held again, and we rallied to the 21-day. Now, similar fashion here, we have a 200-day and Fibonacci support at that 14,000 level. So if we do get that scenario where we pull in, look for NASDAQ 14,000. Now, one of the most curious charts I've ever seen is the small caps, which is moving sideways. And we pointed that out back in July. We had the 50-day and 21-day just sideways, and the 200-day moving up. We were stuck in this sideways trading activity and said, well, what is going on here? Are we going to break out eventually? Well, let's see. Fast forward. We tried, pulled back. We tried, failed, pulled back. 210 continues to be support. 230 area is sold. And now we are really consolidating in this 220 area with the 200-day moving all the way up here. We have the 50 and the 21-day all lined up. This is so rare. This hardly ever happens. And we are just in a flat line now in the small caps or the IWM Russell. Now, if we move lower, this 210 will break, and maybe we can get 190 to 180 as a viable area for eventual move next year higher. Otherwise, if this can hold up, we can sneak back, and maybe the small caps can lead us higher. But very choppy, interesting market in these small caps. Looking at stock specific, we got a couple for you. I drew a fib in Amazon months back from the pre-earnings highs to lows, and it gave us a 61.8, which the shorts held, and we broke the 200-day and almost looked like we were going to come in these targets. This is the target I used, negative 23.6%, but we bounced back to the 200-day. So now there's a fight going on, and if we do get the market scenario come back down, we could get this level. So watch out for Amazon. I would definitely buy it in this area. Apple, very strong. Once again, fib and 200-day lining up. And they front ran it recently and bought it, defended it, and that's how strong Apple is. Couldn't even get the 200-day. So one of the stronger stocks out there. If we do get a market break, perhaps this flushes down to the 130, maybe even 125 area. I would say that's a long-term buy. So Apple looks good. And I just want to show the long-term chart of the S&P 500. We had the COVID crash, and here's that channel I've been talking about. We could actually bring the top end of this channel in as a new one has been formed in the top end. But the point is the bottom end has broken, and the bears are now in control. So the bulls need to come back above that 50-day, get back into this channel to continue higher. Otherwise, we could see some retracement lower. Just considering the move that we've had, it's just not a surprise to see some things cool down a bit. So to summarize, a little short-term bearish here, but nothing that can't take us higher into next year. So that's my technical view. Have a good day.
Sheraz Mian and Jeremy Mullin agree to disagree right after this list of recent Zacks Ultimate top movers.
Hi, Sheraz Mian here with the Agree to Disagree segment with Jeremy Mullin. The topic Jeremy and I will discuss is whether the market has topped out for the year already or not. Jeremy is off the view that it has. Will be making the opposite argument. And before I present my arguments, two arguments, in fact, of why I feel the market will continue to make gains. Before I do that, let me explain what the topic is not about. The topic is not about whether the market has made a peak forever or the long term. It is just for the remainder of this year. So we're basically talking about the remaining 10 or so weeks of 2021, whether there is a chance of the market improving on the early September top it made. And I, as I mentioned, believe it will. And the reason for that is that the fundamental underpinning of this market, which reflects a strong economy, an impressive earnings outlook, in a very market-friendly interest rate environment, that underpinning is still in place. There's no fundamental change in that core driver which has given us the stock market strength. So there have been some new questions. There is the inflation question, the supply chain disruptions, the rise in input costs, whether those are temporary or transitory, as the Fed and the consensus view is, or this is something more enduring. And if it is enduring and the market comes around to that view, that will be dislocating for the market and it will have trouble improving upon the early September peak. I don't think that's the case. I strongly believe that the Q3 earnings season that gets underway this week will reconfirm the transitory nature of these supply chain issues. And if there is any enduring aspect to these issues, it is unlikely that we will hear about that any of these companies will tell us that they expect these issues to remain with us for 12 months or 18 months. So absent that, the outlook, the fundamental outlook for the economy and for earnings remains intact, and that should give us the top for the market. The second issue is interest rates, and it's related to the inflation question, the transitory question. The Fed has been very transparent and very open in articulating its view of how it plans to proceed with the taper and then down the road with the Fed funds rate. And while any change in Fed policy is always a destabilizing development for the market, I believe this change has been so well telegraphed and the market is so well aware of what the Fed plans to do here that I can't envision there being any element of surprise or disruption. So given these two reasons, the fundamental underpinnings of the economy and the market remaining intact and the market not being surprised or spooked by what the Fed is going to do, I envision the market making a new top through the remainder of the year and exiting the year in flying colors and with the wind at its back. With that, I'll pass it on to Jeremy.
Thanks, Sheraz. I believe there are far too many headwinds to get back to those highs of 45.45 in the S&P 500 this year. Granted, it's only a 4% move from current levels, but there are four main reasons why new highs will be difficult. So let's get into it. The first problem is the supply chain. We keep seeing these issues persist, which is slowing down commerce. I can't even find a place to buy a new couch without having to wait 2 months. The supply chain is broken, which is worrying analysts as we head into the holidays. The demand will surely be there, but will the products? We have recently seen supply chain issues affect earnings and cause guidance cuts from Nike, FedEx, Oshkosh, Bed Bath, and more. Of the 26 S&P 500 firms that reported results since the start of September, 18 of them have mentioned supply chains on their earnings calls. Is this a preview for what's to come this earnings season? If so, the markets will have a difficult time attracting the bulls back in. So, next issue is the Fed and inflation. After the last meeting, we saw rates starting to move higher, and they haven't stopped. Tapering is starting soon, and the Fed's next focus will be lifting rates. It looks like the market is jumping ahead of that idea as 10-year yield moves above 1.6%. Inflation is accelerating, and now the Fed might be forced to hike rates if inflation ends up not being as transitory as they think. Energy prices are becoming a major issue globally. This risk came up rather quickly as natural gas, crude oil, and coal prices have accelerated higher. On the energy front, the real risk is potentially higher prices that consumers would pay in a cold winter. This could be a massive tax that would hit global economic growth over the next few months. But it's not just energy. Other commodities like cotton, coffee, lumber are ticking higher. The bears see inflation as a big issue, and CPI data will be extremely important going forward. Okay, the debt ceiling. This is perhaps the most annoying headline risk ever, but the debt ceiling is back and the political rhetoric is stronger than it has ever been in the past. Congress always raises it, but this time they kicked the can down the road until December. Until this clears up, it will be a headwind for stocks. While I do think this ceiling is eventually raised, until we get past this conflict in Washington, buyers will hold back. And of course, there's Evergrande, the Lehman of China, $300 billion in debt. It's the real estate giant that's going to be a problem going forward. I just saw today that they didn't pay more notes, so what's really going on there? While there appears to be limited exposure to companies outside China, there's $300 billion in debt on the books. Because it's China, we simply don't know who's exposed here and how big this could be. While the Evergrande problem has faded recently, the issue still has to be monitored in case there are more defaults that spark larger contagion outside of China. All right, and I just want to look at a chart of the S&P 500. We can kind of see this channel that's moving higher, and I just really hate being bearish, but when charts signal caution, it's hard for me to ignore. So for almost 18 months, the trend line that was formed after COVID crash broke in late September. So you can see right here. We've also broken the 21-day and 50-day moving averages, both of which had turned lower. Additionally, the 200-day in the S&P 500 is right here at 41.54. Now, the bears will clearly try to reach for that level. And if the bulls want all-time highs this year, they will have to take the 50-day back first. So there's going to be a fight in here. And if the bulls can get back above here, perhaps there's a shot at new all-time highs. But I really think the bears are going to push for this level. So to summarize, I think the market is topped out for 2021. We can even go about 5% lower into year's end. However, none of the risks I laid out should hamper a solid return to highs next year. Okay, that's it for my view on the market and my expectation that the bulls hold off until 22. Thank you very much.
Ahead of the Zacks mailbag, here's this list of recent Zacks Ultimate new editions.
Hi, I'm Kevin Matras, and this is the Zacks Mailbag. So, a common theme in the emails that I had gotten this month was, what about the recent pullback, and where do we go from here? So, that's what we're going to be talking about today. So, the pullback. As you know, stocks pull back at least 5%, roughly 3 to 4 times per year. They did that back in late February, early March, so that was the first time this year. And they just did that again for the second time last month. And from the recent highs, the Dow, at its worst, had pulled back by 5.66%, the S&P by 5.87%, and the NASDAQ by 8.38%. Now, that has been lessened recently, but it still feels like that this pullback or correction may finally have come to an end. So if that's the case, now what? Well, for one, I do expect volatility to stay, but I'm also expecting stocks to press higher, and here's why. After Congress last week avoided a government shutdown, and after last week's jobs report, which really wasn't that bad, the market will now turn its attention to earnings season this week, and really for the next couple of weeks. And since stocks typically go up during earnings season, that is a positive for stocks right now. Second, within the next few weeks, Congress is expected to either pass or not pass the $1.2 trillion infrastructure bill, and then a reconciliation bill that is probably going to total at least $2 trillion or somewhere in that range. Who knows what the final price tag is going to be, but it does look like something is probably going to get done. And really, once you start talking about trillions of dollars, I mean, that is an enormous amount of stimulus money that could be injected into the economy. Then, when you combine that with record high corporate profits, an extremely healthy banking sector, household income that is at decades highs, and then you still have interest rates that are remaining near record lows, you literally have all of the ingredients for a rebounding economy and a soaring stock market. And even without the stimulus, we do appear to be on pace for more record-setting growth. But with more stimulus, I am reminded of what Jamie Dimon said in his annual shareholder letter earlier this year. He said, this boom could easily run into 2023 because all the spending could extend well into 2023. That's a pretty bullish forecast, and that seems to be the consensus because full year GDP is expected to come in at the fastest pace in 37 years. Growth outlooks were just raised for 2022 and 2023, while simultaneously inflation outlooks for 2022 and 2023 were lowered, and they were lowered to 2.1%. Plus, two, interest rates are likely to stay at zero for the remainder of this year, probably all of next year. And even when they do begin to raise rates, it's probably going to be done very slowly and incrementally, and we are essentially starting from zero. Now, I bring that up for this reason, because it should be noted that over the last 50 years, there has never been a recession aside from last year's pandemic-induced plunge when the Fed funds rate was under 4%. So even at quarter-point moves or even half-point moves, it will literally take years from where we are in order to get to that level. But in the meantime, the economy continues to rebound. Then, when you have this promise of these new COVID therapeutics, which, pills that people could take to combat the virus if they get it, the U.S. economy and really the world economy looks set to soar as it looks like this economy is finally going to get back to normal. It's going to take a little bit more time, but it looks like you're going to see a lot more growth as that happens. So the outlook for the market remains bullish. So I would say keep your eye on the big picture, try not to get sidetracked, and just make sure you're taking full advantage of it.
Sheraz Mian and Jeremy Mullin will have the portfolio makeover after these interesting insights from Zacks Ultimate editors.
Sheraz Mian here with the Portfolio Makeover segment. Jeremy Mullin will be joining me in this month's portfolio discussion. Each of us have picked one portfolio that you guys have sent us. The portfolio I picked and have added to the Zacks.com tracker is from Linda S. Let's jump into Linda's portfolio on the Zacks.com portfolio tracker. So as you could see here, Linda's portfolio has 18 names. The WBA Walgreens Boot Alliance is at the bottom, and you could see there's 1 to 18. So for my taste, 18 is a bit on the short side. It's hard to achieve the full degree of diversification in a portfolio that size, though it's possible. It's not impossible to do that. The second thing I want to point out in Linda's portfolio is that Linda primarily has exposure to 2 sectors. It has a sprinkling of industrial and transportation, but it's primarily a tech and retail portfolio. So as you could see, Applied Materials, Amazon, and there's Facebook there, and Pinterest. So there's a bit of pharmaceuticals, there's a bit of industrial. You see Deere there. And then you have Costco. So nothing wrong with having a very concentrated portfolio, but that should not be by accident. A concentrated portfolio that's execution of a strategy that you have is perfectly fine. If not, the best way to go is to have a diversified portfolio. I personally prefer in this time in the market to have a cyclical exposure. Linda does have a bit of industrial, a bit of retail. I would have preferred some energy. I would have preferred some materials. I would have preferred some financials, particularly the banks and brokers. But that's not where Linda is. On the whole, these are excellent, high quality stocks. There's a couple of them that I don't fully follow. I believe these are SPACs. But on the whole, Linda's choice of stocks is pretty good, and she has a fairly unique diversification strategy at play in the portfolio. Well, then I'll pass it on to Jeremy.
Thanks, Sheraz. I will start by getting to Daniel's questions first. He says, I'm 60% in cash and I have a hard time figuring out what positions to add. Lots of analysts keep talking about a correction, so I'm not sure when to get out of cash. He adds, I'm 44 years old and my investment timeline is 25 years. I'm trying to get closer to 20-25% return in the next 5 years, jumpstart my portfolio. since I feel I've started late. Okay, let's take a look at this portfolio. Okay, my biggest issue is that you have too much cash with a 60% position. I understand favorable pullback, but that money will work for you better over the long term if you are invested. If you're nervous of a pullback, perhaps spread your exposure over some defensive names, perhaps some staples, utilities, or gold miners. The point is, this money needs to go to work, or you'll be behind at 50 and 60 years old. The other thing I'm seeing here is you have 1% positions in this portfolio. And my question is, why not 6 or 4 or 5%? Why not, if you have a great idea, put that cash to work? If this was 5, 5, 5, 5, you wouldn't be at 60%. So what I would suggest is upping your tier size for every time you enter something, perhaps do 5%. That way you'll put this cash to work. I analyzed what sectors you're in. You're spread out okay. Service and goods, 26%. Technology, 14%. I'd love to see this up a little bit more. Because since you have 20 years and tech is the hot spot to be. A big problem I have here, the large cap, 80%, mid cap 15%, small cap only 3%. Now, this is the highest beta. This is going to be the most risk, but also the most reward. And over 20, 25 years, you need to be in small and mid caps. So I would get rid of some of your large cap exposure, maybe bring it down to 70. Small caps need to come up 10 to 20. Mid caps need to come up 20 to 30. If you're over 20 years, this allocation needs to change. And what I would do on any pullbacks in the market is take some of this cash and target smaller and mid cap stocks. A lot of these are have already pulled back a lot, and they're under the 50 and 200 day moving averages. So when you're putting money to work, try to target some of these names, and remember to increase how much you're putting in, because this percentages on some of these stocks are just too low. Okay, so you have a lot of ones in here. That's good. Some 3s, a 4, and a 5, and you're short the 5, so that's a good sign. Now, looking at these individually, we'll look at in alphabetical order, and we'll go through these, and you can kind of make the call yourself on what I'm saying today. Best Buy. Well, we have the rank. Earnings look great. We're below moving averages and come off the recent earnings report. It looks technically weak. Now, your allocation is lower, so perhaps you buy the dip on any further move lower. Canon. Cameras, the industry leader, nice dividend earnings chart, looks great. I would increase your allocation, which is low. Columbia, a lower rank chart, not looking so hot since last EPS. Under moving averages, would need to move back over 100 to change momentum. Perhaps you just give up on this one. CVS, trading sideways after earnings beat in August, 2.4% dividend is a good place to sit, especially if you're up 20% already. DVA is interesting. Kidney dialysis is a niche healthcare name, a nice rank, great earnings, but the stock has fallen 17% since those EPS highs. The company is involved in a conspiracy case with the DOJ that I know nothing about. So without digging in that, it's hard for me to comment on this. But I would say until that's clear, I would be cautious. Net T's, you are short this one, but it's moving higher lately. When you're short a stock, you have to have a hard stop. Perhaps a move over the 200-day at 105 might be that place to give up on that short. Target, great name, hot stock out there earlier this year, but it's pulled back, still up 20% on the position, coming in the 200-day moving average. I think you can sleep safe knowing that a lot of buyers will be at that 220 level. Tilly's, niche retailer with a high rank. If the market sells off, the stock is likely to come down to 1150, 12 area. I would be a buyer, and since you only have a 1% allocation, I think it's a great spot for you to add to this stock. TX is a steel company out of Latin and South America. Steel's been hot, but recently we've seen an aggressive pullback, almost to the 200-day. Perhaps you add to your position there. UPS, earnings recently killed the stock, and technically it has broken down. I wouldn't sell it here, as the dividend would likely end up supporting the stock. However, adding is, I'm not too sure about that. It might have some issues going forward. Verizon, what an interesting sector stock. The stock, it just continues to slump as the sector is very weak. The almost 5% dividend should be enough for investors to step in soon. However, AT&T is 7.7%, almost 8%, and that's still going down. So there's an issue here in this sector. It might be the streaming companies taking market share. It might be something more than that. But there obviously is an issue within this whole space. Westlake, great chart. Great earnings. One of the strongest charts I've seen lately, actually. Nice bounce back after a summer sell-off and close to 2021 highs. You only have 1% allocated here. So this is a great example of why don't you have more? Why isn't some of your cash put to work here? ExxonMobil, close to those 2020 highs with crude over 80. Exxon looks strong. This looks great with oil marching above $80. Okay, so the key takeaways here. The big problem is not choosing the wrong stocks, but rather being underinvested. A lot of small and mid caps have already pulled back significantly, with a lot of them under or at the 200-day. You should be putting your cash to work in those names, beefing up small and mid cap exposure to get more upside over the next 2 decades. I'd also try to target more tech on pullbacks as well. Look out for those Zacks ranked number 1s and 2s and pay attention to how a stock reacts after earnings this quarter. The winners and losers in Q4 will likely give you clues to stocks that will outperform and underperform next year, so keep an eye on that. Okay, that's it for me. I hope that helped. Have a great day, Daniel. Good luck next year. And to anyone else watching, thank you.
Here are a few things you can expect to see coming up. Make sure to check out the Ultimate 4 report, which includes 4 stocks our team believes have the greatest upside potential over the upcoming quarter. The latest report features the favorite stocks of Jeremy Mullin, Daniel LeBeau, Nina Mishra, and Brian Bolin. Be sure to also check out the updated version of the How to Profit from Trillions in Spending for Infrastructure special report, including 5 top picks in the infrastructure space. Each special report can be found on the Zacks Ultimate homepage. And the next Zacks Ultimate Strategy session will be posted in early November. So start thinking of submissions for the Zacks Mailbag and Portfolio Makeover segments.
My top stock is Dollar General, the retail discounter. On this slide, you could see I've plotted Dollar General. So I've plotted Dollar General here relative to the market. That's the top line, the red SP5M that represents the S&P 500 versus the industry, the orange line. And I've also added Walmart to this year-to-date performance chart to show you how Dollar General compares relative to Walmart in this period. As you could see, Dollar General and Walmart both have been laggards in this time period. By the way, Dollar General is Zacks ranked 3 hold at present. I see Dollar General as a blend of defense and growth. The issues that have kept DG shares under pressure lately is this inflation or rising cost question that we grapple with in the fundamental overview of the market as well, and is the big question in the marketplace at present. This rising costs. There's the input rises, the rise in the input expenses. There's the supply chain and the logistics. In all of those issues, retailers, in particular low margin operators like Dollar General, are particularly at the receiving end, and that's what you are seeing in the stock's recent underperformance. I think it's DG relative to others is better positioned. Also, over the last few years, I think the recent underperformance has given us an opportunity to enter into a quality stock, particularly if you have a long-term view at a much reasonable level. The defense, as I mentioned here, comes from customers trading down. There is significant and sustainable advantages that Dollar General enjoys in its business, which insulates it from the online and the digital competition. This is, as you guys know already, it's no flash in the pan stock. It's a keeper and it's a leader in its space. And I strongly believe that if you have a long-term view, you will come out ahead. Management has outlined a number of operations improvement initiatives that should help it offset some of the inflationary issues that we mentioned earlier. So relative to its peers, the margin impact, the negative margin impact on DG's results should be less than what you would expect with the others. There's a very visible long-term growth trajectory for Dollar General, and this is an excellent financial condition company that should help it continue to grow and navigate this environment. Net, I see the underperformance of DG lately as offering as a lucrative opportunity to enter into a quality retail name, particularly if you have a long-term holding horizon.
Hello, everyone. I'm Jeremy Mullin here today for our top picks segment. Today, I will be doing Thor Industries, ticker symbol THO. Thor is the Zacks ranked #1 strong buy that makes a wide range of recreational vehicles, otherwise known as RVs. The company was founded in 1980 and sells popular brands like Jayco, Airstream, Keystone, and more. Thor is headquartered in Elkhart, Indiana, and employs over 30,000 people. Now, after running 4x from the COVID lows in 2020, the stock pulled back from highs and has traded sideways for most of the summer. However, a recent earnings report helped bring investors back into the stock. Now the bulls are looking for all-time highs once again. So let's look at those earnings. Now, Thor investors are used to beating on EPS, with the recent quarter marking the 6th straight earnings beat. This recent quarter, 42% beat on the bottom line, and they saw revenues of $3.5 billion versus the $3.33 billion expected. The order backlog is massive, up 190% year over year. Gross profit margin was also up big from last year, and the company said that demand for RV products remains robust. The only issue is if they can build the campers fast enough to meet all this demand, mostly because of supply chain issues that a lot of companies are seeing right now. Even so, on the call, the CEO credited their team for getting through the challenging operating environment. He added that they look to grow the dividend, fund strategic opportunities, and repurchase shares. With that, the company recently raised its dividend about 5%, bringing the yield to about 1.4%. So let's look at the profile page here. You can see that dividend. And we have about a $7 billion market cap here with a forward PE of only 9. So what that's doing is it's creating a Zacks style score of value. So there's value investors will love this stock. We also have growth at B and momentum at B. And if we look at estimates, we see that the all time frames, the estimates are going higher. And for the current year, we have 1137 to 1369 over the last month. So that's about a hike of 20%. And since EPS, we have seen Wedbush raise their price target from to 140 from 126, and BMO hiked their target, and they have their target at 166. Now let's look at the chart. Okay, here's a chart looking back to 2018. I wanted to show you guys how volatile this stock has been. We saw some missed earnings back in 2018, which brought the stock down. The growth was completely stalled. And then it started to turn higher into the COVID crash. And then we realized, wow, people like campers. And they started going crazy for them during COVID. And we've seen all those earnings beats over the last year and a half. And then we pulled back on supply chain worries. But turns out supply chain isn't hurting them as bad. They're doing a great job. And we had this earnings that brought the stock back up here. So let's zoom in on that area. And you can see here's the earnings report and the subsequent move. Now, let me go back real quick because I want to show you the Fibonacci retracement that I'm getting here. Drawn from these lows to highs, we get this 61.8% level that has held 1, 2, 3 times. Now this is sloppy. It's back under the 200, over. It's very confusing for those relying on moving averages. However, the 61.8 held every time. And when I get my targets for this are 165. That's the negative 23.6 level. So how do we get there? Well, the earnings was great. That's a start. Over the 200-day, backed off, held the 200-day, and kind of testing out the waters here. Now, if I draw a fib from these highs to those lows, we get 61.8 at 131 area. So if we can get a move over 132, perhaps we can accelerate. Anybody short the stock, they're not going to be wanting to short over that level. So that could take us higher into these targets. And I do have, with this, whenever 61.8 breaks, I use this as a target at 161.8. So we have a zone here where we could look for perhaps next year sometime if the supply chain worries go away. So as far as risk reward, I love it. You can get long here against the 100 level, so that's about 25 points to make 40 to 50 points. That's a great risk reward to put on a maybe 3 to 6 month trade. Okay, that's it for me and my top pick and all of us at Zacks.com. I hope you enjoyed the Zacks Ultimate Strategy session. See you next month.